Good evening. So tonight we're going to talk about stocks and bonds. So it's more in investing. There's obviously all different types of investing. Real estate, um, even precious metals, crypto, collectibles. But stocks and bonds, and stocks primarily, are really one of the biggest and the best investments. They can be a little volatile at times, but in terms of yield, in terms of performance, they're greatly whatever. They just can't be matched by the majority of investments. Um, since the Now there's going to be ups and downs, and this year is obviously a down, but since going back 120 years, 10% per year is pretty much what they've been earning. So I can show you some of those charts later on. But anyway, when we talk about stocks, we're talking about so a lot of terms, but they're they're common, kind of common sense. When we say equity, they talk about trading in equities. Equity means an ownership position, right? In a stock, you own equity. You own a portion of that company. And so companies will sell stock or they'll have one of these big banks that you hear of. You hear of like, JP Morgan or, oh, I don't know, whatever, one of the big Wall Street banks. And you're like, what? Who, you don't see branches. They're not like Wells Fargo or something like that. Goldman Sachs or something. You don't see their ATMs. No, they're not typically those type of banks. They are the big commercial banks that are in the process of working out these transactions for these corporations and then trading things on the secondary market. So, a big company, for example, they don't typically go to a bank to borrow money. I mean, the amount of money they need, and now there's just better ways of doing it. They can sell stock, so they can, you know, um, organize stock and legally split up the company into various shares and sell some to generate capital to generate expansion. Now, if they're not interested in that, they can also take a loan, or maybe they can't sell stock, like they're a government entity, where the concept of selling part of your country that wouldn't be allowed. Anyway, they can sell bonds, and bonds are just a loan vehicle that we'll talk about later. So anyway, so stocks are just portions of companies, and then there's these stock exchanges. So that's one level lower than the banks. And like I say, most of the time you buy stock, 99 point whatever percent of the time you buy stock, you're not buying original stock from the corporation. You're buying stock that already is out there, and it's held by some other investor. And the markets perform a function to perform. They find whatever price discovery. When somebody says, "Oh, my car's worth 10 grand," that's meaningless. Unless there's somebody standing there willing to pay you 10 grand, it's not worth whatever. And the same thing is true with stocks. When a stock is valuable, it's valuable because somebody's willing to pay that. And then there's typically a bid ask type thing where there's a price where there's somebody willing on the other side to sell at a certain price, and then somebody is willing to buy at that price, and they kind of meet in the middle. And if the price is set too high, then the buyers are not interested. If the price is set too low, then they buy all that's available, and you know whatever the prices are, they reflect the true value of something, because the true value of something is what somebody else is willing to pay for it. So anyway, it does, add some volatility, but it also, you know, provides a market, and a market is very, very important for, fluid economies. Anyway, New York Stock Exchange, rather large one. When I buy stock in different companies, I don't care what exchange they're traded on. I guess it used to be a bigger deal, but now you go, I want to buy whatever number of shares of Shopify or Sea Limited or something like that, and you know, it generally you just type in the order and what exchange it goes to or how it's all done. That's not necessarily my concern. Now, a lot of people, you know, maybe a company that's listed on the New York Stock Exchange might there might be some prestige to that, and there might be some, that company might be, you know, represent more value or more of a solid investment because it's traded on the New York, which is a bit prestigious. But uh, and then the floor trader bit, um, yeah, floor traders, it's just not fast enough. People will want to be close to that exchange, but electronically close. I mean, digitally close. They they literally, this whatever electricity travels at the speed of light, so 186,000 whatever the units are. I mean, friggin' fast. But hey, it makes a difference when you're trying to execute trade. So they want the cabling, whatever number of meters shorter to get things going to kind of anticipate. And there's some complex trading strategies you can do. We could get into Robinhood and some of that kind of stuff where they sort of anticipate the way the direction the market's going, and by being quicker, they do some devious stuff where they're um, essentially putting in orders at the same time, but because they have shorter cabling, their order actually gets executed. So anyway, that's down in the minutia. So we know what stock is. It's a portion of a company, different types of traders, yeah, specialists. But again, the guys that are yelling out trades, that's more of a Hollywood thing getting to be. American Stock Exchange, other stock exchange. You'll see some other ones or foreign stock exchanges. Um, for the most part, let's say you want to buy part of a Chinese company or a British company or whatever. You don't need to travel to those countries. Typically, you can find, I've got a pretty big chunk. I wish I didn't right now, but a big chunk of a company that's based out of Singapore and it's traded on the U.S. exchanges. So the tax nightmare, the currency swaps, everything else, if you try to trade on foreign exchanges, it would eat up all your profits and make it so much more complex. You can invest in other nations if that's what you choose to do, um, without visiting those other exchanges. And then when these physical exchanges, though, again, NASDAQ, the whatever, National Association of Stock and Security, whatever, it's a big long acronym, used to be fairly small, used to just deal with the high tech stuff. But as the high tech market has kind of grown, and those companies that were originally on the NASDAQ, they've sort of stayed there. And NASDAQ is now, and NASDAQ doesn't have necessarily a physical location. It's just out there in the ether, it's digital. So this discussion, what I'm trying to say is, um, don't sweat it. I would say there's some prestige being a company listed on the New York Stock Exchange, but that's about the extent of that. So OTC, over the counter, which just means what I was talking about, like NASDAQ. Market makers, these are people who are, looking for deals, either on the high side or the low side. And they're the ones, when somebody sets a price and the people will evaluate it, and if it makes business sense, they'll buy it. And these people trade back and forth, and they essentially determine the price. Less stringent listing requirements for the Nasdaq. So again, there is some prestige to being traded on. I mean, on the New York Stock Exchange, not Nasdaq. Um, anyway, these guys are kind of slow to catch up to the internet. After hours trading, no person could perform the trade. It's too fast. And there are still, most of the trading does occur during the business hours. But yeah, there is some after hours trading, but that can get a little dangerous because, like I said, on every trade, there's somebody, a buyer and a seller. Well, if after hours, if there's not very many people participating, you'll see this happen around maybe Christmas time, even when the markets are open, but everybody's off doing something else. You'll see some price swings sometime just because there's not enough people participating to prevent those swings. So, anyway, price quotations far easier than what these guys are going to portray. There's so much power out there with charting apps and everything else, and just some real, genius people that obviously, if you're a genius and you want to make money, the one of the places to apply that knowledge is in determining which way a stock is going to go. So there's different ways to figure it out more than just fundamentals. Fundamentals would be, it's a good company, a bad company. Now, that's important, but there's also technical analysis and some other things because people are involved and people, a lot of psychology and they react certain ways and they anyway, they can be predicted based upon charts and other things. It's quite interesting, but if you don't know what you're doing, kind of quite risky as well. So anyway, yeah, screw the previous day. I want to know the previous year. I want to know in real time. I want to know everything, and I'll show you how that's all available. So this is, old school when they're listing a newspaper. Number one, that's too late. I want to know what it is now. This, by the time it's printed in a newspaper, it's not what I'm looking for. So anyway, what they're doing here though is they've got a stock quotation, right? So the high, this was a 52 weeks, so over the course of a year, the price was 62.10. The low was 49.40. The stock, I guess this would be their ticker. Typically, a ticker is a little bit shorter than that, not normally a whole word. Like for Ford Motor Company, it's just an F. And for Tesla, I think it's TSLA. Anyway, some of you guys have probably traded some of these stocks, um, price earning ratios, volume. This is kind of interesting too. Now, a tabular data, not so interesting, but if you see it on a chart, you go, oh, okay. It's, we function much better on graphical information, and so you can see trends developing. Just a static snapshot is not as useful. The day before it closed at 50 bucks, so it's pretty damn close to the low for the year, so it's down a bit. Net change, it was up 27 cents, so that day before it was down pretty darn close to the low. So let me show you something real quick, just to show you what's available. Um, so I talked about a company called Sea Limited, that Singapore company, which you can see why I wish I didn't own it right now, right? Oh well, bad things happen. It'll come back up. But I mean, look at that growth. You're just, May, whatever. And the beauty of this, so remember that tab data that they had before, it gave you some information, but look at these volume numbers along the bottom. That's way more useful. And it's interactive. When I move this cursor around, it tells me, the top up here was almost 360 bucks and it happened on November 1st of last year. And let's see, November whatever of the year before, it was trading for 186. So it was double. Now it's way less. Is it going to come back? Probably so. These guys do some stuff like kind of an Amazon type business, but over in based out of Singapore. So in Asia, and they're going to South America and some other things. Obviously, they've got some issues, but the market in general has taken pretty big dive. But this was definitely a speculative stock. So people are bearish long term, bearish in the midterm. So bearish means they expect it to go down in the long term. But again, these are advisors. If I have great information, am I going to share it with everybody? Yeah. I mean, some of these other things are useful, and we haven't paid a dime for this information. So, be careful. Um, they will give you some information. This is Yahoo. I mean, Yahoo's kind of I don't know, not a search engine I typically use, but for finance type stuff, And if you're associated with a brokerage firm or some investing company, you'll have access to this type of information. Google's got similar products, has similar products, and the rest of it. But it's just so much more useful than um, others. So I'm typing in a ticker, right? I typed in a ticker, shop, which is the ticker symbol for Shopify. Another company, they do work with Amazon and some other people in terms of e-commerce type stuff. But look at what happened to their price. So when on that previous slide, you go, wow, that C Limited, that's a horrible company. Well, in a bad economy, a lot of companies are getting beat up. But we look back at the max, and yeah, you can see there's been dips before, and there'll be dips and dips again. So it's not for the faint of heart. This is a pretty brutal dip. Don't get me wrong, but there's a lot of moving parts right now. Not to get political, but no, we're not in a favorable time. That's for sure. Okay, so selecting a broker. Um, I would say selecting a brokerage. I've worked with individual brokers before back when I had to, and it wasn't a pleasant experience. These guys are on commission, and the basic thing was I'd buy something, and then about 6 months later, I'd see the stock price dropping, and then I get a letter from a whole bunch of other investors saying that the brokers misrepresented it. Payne Weber or whoever, some of these defunct brokerages, they actually had a position, and they weren't giving you the best advice ever. So I'm not a big fan of brokers. Now some of these recommendations and must disclose, yeah, sometimes that's usually what the lawsuits were over because they didn't disclose. But there are other mechanisms you can use or other people's advice you can get. I used to be part of a thing called Motley Fool. It's just a subscription service. And there's other newsletters and people who are just independent who they aren't necessarily going to get a commission from you buying or selling, and that's what you want. You don't want somebody with a problem in terms of whatever the advice you get. You want fiduciary advice. You want advice that is focused solely on your best interest, where they don't have a competing problem like will I get a commission or I need to sell this stock because this is the one our company's pushing right now. So now there are still, some brokers and some personal advice, but they're generally up with the high wealth individuals. And so, you know, you or me with our whatever amount of money, and believe me, we're talking, people with over millions that might get personal advice. Anybody else, down in the hundreds of thousands, you're kind of a schlub, and you're better off getting advice other places. Or now you see, with Wall Street bets and some of these other things where they kind of, crowdsource the information and they beat Wall Street at their own game, which is quite interesting. So, brokerage commission. So there's really no need to be paying them anymore. Everything is pretty much zero. There are still some companies out there, but again, I haven't paid a commission in at least 10 years. There are a few kind of upstart, you know, internet-based companies, and now they're all on the internet, and now they're all um, commission-free. So, um, placing an order, not at all hard. That ticker symbol, that will get you the quote, and then you put it in, and it's quite easy. Buying or selling, yeah. Now you can sell things you don't have. That's called shorting, but we're not going to go there. But it's a useful technique, but not something that we would typically be talking about in terms of investing. You're starting to get into speculation when you're shorting a company. And then the number of shares. You don't have to mess with round lots anymore. This whole being sold in multiples of 100, absolutely not. You can just, they don't even use these terms anymore. So again, the authors are getting a bit dated on their info, because again, there's not a man in the loop. The computer doesn't care if you want to buy. Now, I generally buy even numbers of shares, like 71 or 72, or something like that. I don't buy a dollar amount. Normally, if you're buying mutual funds, you typically buy mutual funds, which are a collection of stocks. You buy those in dollar amounts, like say 500 a month or something like that. But with stocks, let's say you're going to buy some stock and it's trading for whatever price, there's typically a calculator feature on your brokerage website, and it will tell you, say you want to spend $1,000, and it tells you basically the even number on that is, equates to say 85 shares would be $995, and you go, yeah, close enough. I'll buy, 95 shares and it'll be done. Lightning quick. So there's all sorts of neat ways to do this too, in terms of, and this is all strategy. There's not a right way or a wrong way, um, but you may, number one, the reason why I think it's a good idea to trade stocks, individual stocks to a small amount, not your whole savings, but you know get a feel for it, because if you're going to be investing over the course of your life in mutual funds and other things, it's good to understand how the underlying stocks work so that you're more you understand the process better. So when you're evaluating the performance of your mutual funds, which is probably where the bulk of your money's going to be, if you're in a retirement plan or something like that, typically that money's going to be in mutual funds. But you with some of your personal money might decide to buy some individual stocks. Anyway, so let's say you decide you want to buy something. You can say, man, the stock's down today. The price, it looks good, or it looks like it's going to go way up, and I want to get in right now. That's a market order. That's you're buying at the market price. If it's trading for, $65.02, you you know type in the thing, hit 100 shares or whatever it is you want to buy, and boom, you put the order in, and that order is going to come in pretty close, especially with high volume stocks and the rapidity of the whole system. Assuming you got a real time quote, nothing's delayed. You're probably going to have that trade executed right at the current market. Um, Now you could also look at a stock, and you've got a job. You don't necessarily trade stocks for a living. You don't want to sit there and watch it all day, and it's really not that efficient if you're just trying to buy stock and you want to buy it at a certain price. You can just sort of set up an automatic order. A limit order would be one type of thing like that, where let's say a stock is trading in a range between 60 and $65 or something like that. You see from the chart that it bounces around, and right now it's at $65, and you're like, I think it's going to probably bounce back down to $60. You can put in an order, and with a limit of 60, uh, that will buy when the stock price hits 60. So what happens in that order is, you type in all the details and you make it a limit order for $60. And when that stock price descends down to $60, your limit order now becomes a market order, and it will, be executed. And so, if it's a super fast moving market, you might get in at a lower price or a different price, but it's typically gonna be pretty close to that $60 that you're looking for. And then stop orders. Stop orders are, I've did this quite a bit in the fall, and I had some luck with it. But what I was actually doing was a trailing stop order. But let's say let's say you own some stock, and it's that same stock. It went up to $65, and it's now at like $70. And you know that the stock sort of trades down in that 60 to 65 range. That's where you saw it go before. But you know what? It's already up at say $70, and you're like, man, it might go higher. I don't want that price to, drop back down to 60 and me lose all my profits. So what I think I'm going to do is I'm going to put in a stop order, and I'm going to put in an order that if the stock price drops, say back to 70 bucks, my order, my stop order is going to become a market order. It's going to get executed. But if that stock price keeps marching up, say it goes to 80, 85, and it never touched that 70, then my order's never executed. And so you have sort of that floor that's been established by your stop order. So you can see where that could be kind of useful. Now, what I did was, that's not, my own idea here. That's one of the features on all these sites. I put in a trailing stop. And a trailing stop, what this did was you can put it in either for a percentage or a dollar figure. And let's say that stock's trading at whatever, 70 bucks, or let's say 80 bucks. You can put in a trailing stop and say, put in that trailing stop for $65, meaning if that stock price descends to 65 bucks, my order becomes, a market order and gets executed. But if that stock price, say, goes up to, 80 bucks, my stop order, which is a trailing stop in this case, trails up behind it and establishes a new trailing stop level of say 75 bucks. It stays $5 behind the all-time high. And so if that price, happens to go up to 120 bucks, my stop order would now be at, 115. It'd just follow right along and it just kind of ratchet right along with it. Now, it'd be kind of dangerous to have a trailing stop that's that close to the actual sales price because a little bit of volatility, you know, throughout the day, the price swings just a little bit and boom, your order gets executed. And so let's say for, by chance the stock is sitting at about 130 bucks and all of a sudden it drops to 115 and then continues on up to 140, 150. Well, too bad for you because once it hit that trailing stop level, you're out of that market. So anyway, lots of things you can do, which typically you cannot do with mutual funds. Mutual funds are kind of a buy and hold instrument meant to be kind of slow and boring. This is just sort of interesting stuff, but pretty useful. So we talked about stop orders. So you can buy stops, sell stops, certainly. Placing orders online, low commission, no commission. Yeah, commissions are kind of gone by the wayside. If you're paying a commission, you probably need to find a new broker. Buying stock on margin, dangerous. Okay, so what happens here is when you're buying stock on margin, you're buying borrowed, you're borrowing money to buy this stock. So Federal Reserve limits margin to 50% by law. So, Federal Reserve, pseudo governmental agency anyway, the power to set limits and do things like this. So if you buy some stock and you margined it up to the hilt where you're right at 50%, well, that means, that 50% that you don't own, the collateral for that is the underlying stock. And if that stock price happens to drop, well, the broker's kind of in trouble, and in this case, it's going to be a little email or a message to you saying, look, the stock price has dropped, therefore your collateral is not 50% anymore. You need to add more money to this account to buy more stock to get, you borrowed money in dollars and your collateral is in shares of stock. And when those stock shares, the value of those goes down, so does your collateral. Well, if the collateral is below 50%, that's no bueno. They will not allow that. So they do a margin call and they say, hey, you know, put some more money in there. You got to buy some more stock. And if it did one of those C limited things or Shopify, and we could look at a number of companies. I mean, those guys are kind of the tech sector, and they're all kind of having a bad day. But you can see where this gets very, very dangerous. I own that Shopify and C Limited outright. So, yeah, am I happy right now? No. But if I lost a dime, well, no, not until I sell it. And I'm not going to sell it when it's at these low, low prices. So, got to suck it up. When people were, you know, making money hand over fist, I mean, I bought Shopify originally for down in the 70s, and it topped out right around, oh, it was 1500 or something. So, I mean, massive gains, and I sold a fair amount of that, so that was all good. But the stuff that I have now, yeah, all things being equal, I wish I didn't. But anyway, so when people talk about losing money, I mean, yeah, you lose when you sell, but right now it's just sort of a paper loss or a whatever loss. I'm not going to lose. By selling now because if you still have faith in the economy, faith that the markets will come back. And actually, I'm more bullish on, the need for people to buy stuff. I was down in Seattle this past weekend, and oh my gosh, I mean, retail is dying. At least, retail where you in-person retail. So anyway, enough of that. All right. So short selling a stock. Yep, this is this can get kind of confusing, and some of you know this kind of like the back of your hand. Some of you may be doing it. Very speculative stuff, but through the AMC stuff, everybody kind of got an education on this. And what you do is you just sell something that you don't have, and you are going to, let's say you want to short sell something. So I short sell 100 shares of Tesla. And for some reason, probably not a good case now, but you're expecting the price of Tesla to go way down. That's why you did the short sale. Because if you're selling short, you're going to profit if that stock price drops. Because what you're doing is you bought, say, your 100 shares of Tesla now, but you haven't paid for them yet. And what you want to do, if your strategy works out, is you want to pay for them. You need to buy 100 shares of Tesla at some point to cover this short. But if you do it 2 months from now and the Tesla price is way down, you sold something at a very high price and you bought it for a low price. And anyway, short selling's quite interesting. But again, it's we're getting into speculation rather than investing. So there's an opportunity to make some quick money there, but you're really probably not doing personal investing there. You're probably more into, you're an investment professional doing short selling. So it can be fun though, but just don't do it with huge amounts. Technical analysis. So this is sort of that kind of geeky stuff where these people don't even care so much about the company. They're just looking at the charts and they're seeing how the charts go and all these different patterns that have emerged versus fundamental. Fundamental is like kind of a Warren Buffett kind of thing where you look at the earnings of the company, the performance, but when you're pricing a stock is priced on the future value. So Buffett, for example, he knew huge oil boom in with the fracking. He also knew that there wasn't much in the way of pipelines. He also knew that politically he could work to prevent more pipelines, and therefore all that crude oil would have to be shipped on his trains. So he bought CSX. So, when people sometimes are against pipelines or whatever, it's not rocket science to figure out, yeah, there's a ways to make a lot of money. He also owns things like all the different cowboy boot companies. I mean, they're all kind of one company anyway, but whether you're wearing, whatever, uh, uh, Tony Lama or Justin or Dan Post or whatever. They're Buffett owns them, and so he lives in Omaha. People wear boots there. He wants things he can reach out and touch and know everything about. Technical analysis, this is more quantitative type stuff where it's based upon charts and stuff. I've got a huge, renewed faith though in technical analysis after seeing the power in crypto, because crypto is pretty much all technical analysis, and some people do quite well at it. All right, firm's condition. Yeah, I mean, you need a couple different things to do this. Again, if we're in personal investing, oh, this is where I'm saying it's kind of nice to trade, some individual stocks at a small level so you understand some of these things and you can when you know you're not going to be out evaluating companies with much success yourself because that's probably not your day job, but you can look at other people's recommendations, professionals or things that you're subscribed to or whatever, and evaluate their advice based upon the limited knowledge you have to, determine whether you're getting good advice or not. But yeah, so in that analyzing balance sheets, income statements. Also, it's much more effective when they're comparative. When you're looking in a certain segment, you're comparing one car manufacturer to another car manufacturer, in the electric vehicle space, when you're trying to, compare those companies, it's most effective to compare balance sheets of companies that are also in that segment to make meaningful comparisons. Okay, strong sales, investors are confident. So all these arrows are kind of going down right now. Yeah, and it's not so much, the thing that doesn't have me spooked about the market is that all the businesses are getting clobbered. And I don't feel like I've got some, just lousy stock. No, if I see across the board stocks being depressed because of inflation, because of, turmoil and COVID and everything else, I'm not that worried because these things will pass. Accounting fraud happens all the time. And Enron, WorldCom, yeah, there's all sorts of things, but uh, anyway, I'm not gonna spend too much time. But there was nothing unique about these companies per se. There's a lot of crooked people out there. We talked about economic growth, gross domestic product, the GDP, and the fiscal policy. So we're seeing what happens with the fiscal policy. I mean, the people who said that, hey, if you spend money like this, there is going to be some inflation. It's pretty tough to argue that they weren't correct. International economies, they're not as independent as you would think. The U.S. still has a pretty dominant position. There's stories about when the U.S. gets a cold, the whole world or whatever world sneezes or vice versa. But yeah, there are quite a bit of interconnectivity. Interest rates. So interest rates are going up. High tech, super sensitive to interest rates because they're expanding, they're borrowing money. Federal uses, let's put this as tries to influence because obviously they don't like where inflation rates are right now and monetary policy. That's, yeah, the policy that they're trying to do. But again, things hopefully will get sorted out. But it all has to do with the money supply. So inflation. So again, the inflation, you've seen it in so many things, in fuels and everything else, and different baskets of goods that are contained within it, but they'll change the methodology once in a while, and and just screw up any kind of analysis over the long haul. But anyway, inflation in general means that, let's say you've got $100 at the start of the year. At the end of the year, you may still have that $100, but in this case, it'll buy about 8% less. So not a good thing. Does not help people out, including people in real estate, unless you've holding a bunch of real estate to sell. But if you've got real estate that you're living in, the real estate that you would be living in if you sold it is also inflating. So it doesn't quite work out. So anyway, putting it all together. So, what I would strive to is try to have enough financial sense and information and understanding that you can assess things. You're going to be, or I don't know what kind of folks you run with, but throughout the course of my life, there's always somebody with a hot stock tip that's just about always wrong. What you need to be able to do is you need to be able to, look at a company, and this would be more fundamental analysis. Go, wow, that's a good company. Lululemon, I made quite a bit of money off of them. Where you go, wow, I see all the students, primarily females, with Lululemon bags, and it seems like high quality stuff, and it's a growing company. And then, sure enough, it came across recommended on one of the services that I was subscribed to. And then I looked at some of the fundamental data. So it wasn't just, hey, my buddy told me this was a great company. No, you had to verify it. Do not go off on a single source of information, especially these days too, because there's a concept called pump and dump, which is very prevalent in the internet. You can watch Wolf of Wall Street and all that other stuff to kind of get some information. But what you can do is you get a company that maybe isn't a great company, but you generate a bunch of hype around it. So you get this, price of the stock to skyrocket, and you just, people hype it and hype it, and they keep dumping more and more money in because they're getting rich. And then the people who hyped it, when they see it get to a certain level, they sell all that they have. And since they're selling all that they have, buyers and sellers on each side, there's a whole lot more being sold than there is being bought, and the price drops. But those guys don't care because they sold everything. They got a good price for it, and they're off to some other pump and dump. So be very careful of advice that you're getting for free, and any advice in general, because pump and dump is a real thing, whether it be crypto or stocks or whatever. Factors that decrease the stock price. So we're seeing them, the whole thing. I mean, and so, the last one is the firm. If you got a bad firm and they're hit with all these other conditions, but even if you're a great firm, you probably can't overcome all these headwinds. Difficulty, certainly. That's why people are good at it, make money, because it is difficult. And sometimes good companies, just encounter bad conditions. So, all right. So we'll talk more about stocks and bonds and other things as we go through mutual funds, because mutual funds are primarily made of stocks. But um, there's all sorts of sites that will let you trade stocks and without actually spending money. Just like fantasy football kind of stuff. And if you find that interesting, I would recommend using just a small amount of real money. So you get there's nothing like seeing your balance go up and down. Now, obviously, this isn't money you're going to eat with, or even money you're going to retire with. This would just be some extra money, and just see if you're good at it. But be careful. Okay, so investing in bonds. Bonds are not an equity position. They're not an ownership position. That's just a loan from that company or entity. Long-term debt securities issued by government agencies or corporations. So Governments don't go out of business generally. Corporations do. So, corporate bonds are always going to be viewed as a little bit riskier, but they're going to pay a higher yield. Back in the day when was this? 95ish or so, I was getting 8% straight up on a short-term bond every month. It was just awesome. But they don't pay like that anymore because interest rates aren't that high. We may be getting back up there. Par value. That's the face value. So let's say you're going to buy a $20,000 bond. $20,000 is the par value, right? Now, on that bond, you'll also get a payment where they're basically paying you rent for that 20,000. The understanding is that when you buy a bond, what you basically do is you give that company or government agency, say 20 grand in this case, and they get to keep that for a maturity between 10 and 30 years. So they get to keep that money for 10 and 30 years. And then they pay you a dividend payment, basically a rental payment for the use of that money. Now, just like stocks and stuff are sold on the secondary markets, you can sell your bond before it reaches maturity. You just sell it to somebody else. But the price that you receive, let's say it's a $20,000 bond and it's paying 3% yield or something like that. Well, let's say bonds that are being issued today pay 5% because of increased inflation and everything else. But you don't get that 5%. You get, your 3% when you initially bought the bond. So, in order for you to sell that $20,000 bond that's only yielding 3% to somebody who could go out and buy a bond today, a current one that's earning 5%, they don't want your stinky bond. Or if they do buy it, they're going to give you, I don't know, 18, 15 grand, something like that, something less. So bonds are affected by interest rates because when rates go up, your lower yielding bond is not as in demand. Anyway, yep, interest payments and repay the par value. So at the end of the term, they give you your 20 grand back and you get to keep all those interest payments. There's also a thing called a call feature. Now, let's say this is kind of you don't get a call feature. This benefits the bond issuer. And so let's say they're issuing bonds today that are paying whatever 5%. And so you sign up, you invest your money and you're getting your 5%. Well, let's say interest rates drop and now because of market circumstances, they can sell bonds that only pay 3%. And there's people out there in the market willing to buy their, what was kind of a crappy bond, but now that interest rates are down at 3%, um, you know, people will buy them. Well, that corporation or, government agency, if they had it to do over, they don't want to pay you 5% anymore. And if there's a call feature, they may do that. They may say, guess what? You get your 20 grand back and the deal's off. We're not making any more payments. We're not renting that money from you anymore. And so that's a call feature. A feature on a bond that allows the issuer to repurchase the bond from the investor before maturity. And you just say, yeah, the deal's off. Now, because they can cancel the deal, basically, yeah, they're going to have to pay you a little bit more to entice you to even take it because why would you want something that can be, if it starts to be a great deal for you, can be canceled? So, anyway. Convertible bond, yep, something that can be converted into shares of common stock. So it can go back and forth. I've never, well, I've had short-term bonds and other bonds, but of late, the past 10 years before this current administration, bonds were kind of a horrible investment because interest rates were so low. And if you were to buy bonds, chances are that when interest rates start to bubble up like they are now, your bonds would be worth less than you paid for them. So that's why. Bonds yield to maturity. Yep. They have these interesting things. Coupon rates, if it blow, exceed the coupon rate, par values and coupon rates. It's just terminology. Don't get too wrapped up with it. It's just keep it keep in mind the simple concept that the par value is the stated value when you initially bought it, and the coupon is how the yield is working into that. Bond trading in the secondary market. So that's what I was talking about. So selling their bonds before they reach maturity. Bond prices change in response to interest rates, and brokerage firms will sell them. So again, if you have a bond that's yielding, say 3%, and new bonds are yielding 5%, your bond is going to be sold on the secondary market for less than par value. You're not going to get, in this case, your whole 20 grand. You're going to get somewhat less. So, treasury bonds. So, guaranteed by the federal government. So, how much risk are you exposed to? Almost none. And so the interest rate is quite low. There are some tax benefits, but they become more significant if you're in a higher tax bracket. So anyway, can easily be sold in secondary markets, certainly. So T-bills and T-bonds type stuff. Municipal bonds, low risk again because it's associated with a government that typically doesn't go out of business, just can raise taxes. People like them because they're interest exempt from the federal income tax, but typically they pay less because that they're more attractive. So the reason things, the reason why bond issuers will pay a certain interest rate is because they have to. They have to match what the market is willing to pay. If they try to sell a bond that yields 2%, people say, "No, I don't want it. How about a 3? No, 4. Okay, I'll take it." And so that's how the interest rates get set based upon what the market will bear. They'd like to pay the lowest interest rate possible. So again, federal bonds, taxable. Corporate bonds, so inherently, viewed as a little bit riskier because corporations can go out, they can default. I mean, to be true, municipalities have defaulted, and the federal government's trying pretty hard to default. Whether they'll get there or not, we'll see. So one man's, lower quality bond, or in this case, they're calling it a high yield bond. Well, that's also synonymous with junk. So the person selling it's going to call it, high yield. The person buying it should rightly view it as junk. There's a bond rating system, and it's heavily inflated. Triple capital A or something like that is the high rating. And when you get down in the B range, you're down in the junk bonds and companies that may default on you, meaning not pay, just flake out on the whole bond payment. Bond quotations, coupon rate, maturity, yield, volume, closing price, net change. So again, when they're traded in the secondary market, they're going to go up and down like stocks. And again, you can look at this on, charting type data, but probably not quite as interesting. So I think I've said this about 3 times now. If the interest rate rises, the value of your bond decreases. Interest rates fall, the bond value would increase. Tax implications. Interest is taxed as ordinary income, less tax exempt. And then you could also potentially get a capital gain if you sold it in the secondary market for more money. So some of these things with the time value of money and some of those charts that we talked about, calculating that. But again, the company, the corporation needs to make those payments. If they default, then the bond quickly goes beyond junk and into default. So default is the risk that the borrowers will not repay the creditors, that being you. So you've got Moody's or Standard & Poor's. They rate the bonds. Pretty similar systems. But again, this is not something you go, oh yeah, it seems like a trustworthy company. You might want to do that, but again, you're going to want to get some, you know, professional analysis from Moody's or Standard & Poor's to see how they look at the strength of that company. Yep. So you can see that the systems are not too awful different, all caps here, three. Anyway, the big picture is unless you see multiple A's in what you're looking at, you're probably not interested because you can see how quickly we're not even down to single B and we're already talking junk. And you get down into here, they better be paying a fantastic yield because it's probably not going to happen for very long. They're in default. What happened back in 2007, 2008 was they got a whole bunch of basically crappy, if they were independently verified, some of these collateralized debt obligations, some of these mortgage backed securities they had, they questionable, people had bought these homes. Ninja, no income, no job, no assets, and they had 5 homes each. They were poor quality. The chances of those bonds being repaid back, and all those mortgages were combined together and put into a bond. But when they combined them together, they pretended that they had actually moved up in category because there was more diversification and other things. But anyway, it was a big pile of crap, and when you yeah, individual piles of crap, and it added up to a huge pile of crap. It did not improve the content of the pile at all. So, so call prepayment risk. Yep, chance that they might, if there was a call feature. Interest rate risk. Yep, that the rates may change, and you may be obligated into this 20-year bond paying 5%, which you thought was a great deal. And you're going to see in our current economy, as inflation rates go up, interest rates are going to go up high, and 5% may not be that much money. So people put these out in what they call a ladder, where they'll stagger them, and they'll have all these different bonds. I've never been a bond person. Again, it's almost an institutional type thing where you see a lot of the retirement funds and some of the pension funds being more into bonds. Purchase long-term bonds if you expect interest rates to fall. Yeah, because you would make money. But if interest rates were already quite low where we've been the past few years, that's why there's not a lot of interest in bonds because they couldn't fall, you know, obviously below zero. And it's kind of a slower moving thing. In general, bonds, as compared to stocks, are not nearly as dynamic. Yep. And people come up with some sort of strategy where that 20-year bond is going to, you know, child was born 20 years out, 18 years out, whatever. Be nice to have that money rolling in at that point. And that's it. We'll talk more about this stuff as we go. I realize some of this it's kind of hard because some of you you know are probably already buying and trading stocks on small levels just for fun or maybe even larger levels, and then other people it's just brand new and it's kind of overwhelming. But if you find out a little bit about it, number one, it's kind of interesting, but two, it'll pay off huge dividends even if you don't have your primary, wealth and savings in individual stocks. If you know how they operate, you'll understand more about the markets and, frankly, a lot of things, not panic. The worst thing you could do right now would be somebody to sell in this market because if you were going to sell, that would have been back, last November or so, not necessarily now. So anyway, I'll be posting the rest of the material shortly. Good luck.